Hi and Assalamualaikum. My name is SYAHRUZFAIZAL from BA 2422E and I will explain about Chapter 6, Time Value of Money. The time value of money is the concept that a sum of money is worth more now than the same sum will be at a future date due to its earning potential in the interim. Understanding the time value of money essential in financial management. It will enable us to understand how shares and bonds are valued and how the value of a new project is determined. Next, we move to future value and compounding. Compounding is the process of accumulating interest on an investment over time to earn more interest. Next is future value. Future value refers to the amount of money in an investment that will grow to over some period of time at some given interest rate. There are two different types of interest. The first one is compound interest. It means interest earned on both the initial principal and the interest reinvested from prior periods. The other interest is called simple interest. It is an interest that is earned only on the initial investment. Discounting is the process of converting a value received in a future time period to an equivalent value received immediately. It determines the present value of a future sum, assuming an opportunity to earn a certain return on the value. Next is present value. Present value is the current value of a future sum of money or stream of cash flows given a specific rate of return. Present value takes the future value and applies the discount rate or the interest rate that could be earned if invested. Next, we move to annuities. Annuity is a stream of equal value cash flow over a specified period of time. These cash flows are usually annual but may also have other intervals, for example monthly, and may be inflow or outflows. There are two types of annuities. The first one is an ordinary annuity. The cash flows occur at the end of each period. The next one is an annuity due. The cash flow occur at the beginning of each period. The future value of an annuity due is always greater than the future value of an ordinary annuity. This is because the cash flow for an annuity due occur 1 year earlier than that for an ordinary annuity and therefore can earn more interest for an additional year. Next, we move to Chapter 7, which are Working Capital Management. Working capital management involves day-to-day decisions regarding investment in current assets and how the assets are to be financed. Based on the firm's needs for adequate liquidity, sufficient cash on hand to meet all short-term obligations can significantly affect a firm's risk, return, and share price. Working capital can also affect profitability and liquidity. If there is an increase in current asset, the profitability for the company will be lower and the liquidity for the company will be higher. Meanwhile, if it increases in current liabilities, the profitability for the company would be higher and the liquidity for the company would be lower. There are three types of approach that is used in working capital management. The first one is hedging approach. It involves in moderate risk with moderate return. The firm uses the temporary financing to finance temporary current asset and permanent financing to finance permanent asset. Financing activity should match with the asset's requirement. The next type of approach is aggressive approach. It involves in more risk with more return. The company will use short-term or temporary financing to support a relatively large portion of current assets. The firm would finance all fixed asset and part of permanent asset with long-term financing. The last type of approach is publish and share. It has the lowest risk compared to other approach. The company will use permanent financing to finance the majority of its asset. During low requirement, the firm will invest its excess funds in marketable securities.